there's got to be some folks, some listeners, some viewers waiting anxiously for episode 2 of the Jargon Bin. So I'd like to get started with the Multifamily Jargon Bin, where each week Spencer and I are diving into a commercial real estate buzzword, vocabulary word, terminology, or phrase. We're doing it at 3 distinct levels of basic understanding, an intermediate level of understanding, and an industry veteran level of understanding. And this week, drum roll please, from the Multifamily Jargon Bin, we are breaking down the limited partner and general partner vocabulary word, and or LP and GP.
Yeah. There are 2 terms we talk about all the time, get thrown around. And like all of these phrases and jargon and terminology, you get so comfortable with it. And then all of a sudden you're having a conversation with someone. They're like, I don't really know what you're talking about. Or I sort of understand what you mean. But what does that actually mean? Like,
Correct.
LP, people probably think of as an investor, and GP is kind of the guy, the group's running the deals, raising the money. But like, what are those relationships?
And these 2, phrases, limited partner, LP, and general partner, GP, they're very easy to, not Freudian slip, but to interchange and maybe not know that you're doing it in conversation. And it really does matter because they are very different, the LP and the GP, or the limited partner and the general partner. So let's go ahead and let's just get started as the basic introduction to a limited partner or an LP. What does that mean to you on a very base level of understanding?
Yeah, really basic. No, not history right behind the terms, but again, almost like 5th grade level of explanation. A limited partner is the group, the person that puts money into the deal, and the general partner or the GP is the person that runs the deal, that typically raises the money and makes the decisions for the deal itself. And that could be real estate, it could be private equity. Obviously our context, we're typically talking about real estate.
And then just the same level of understanding, who qualifies or who can be an LP, and then kind of on the other side of the coin, what does it mean for somebody to step into a GP role, and how do you qualify as a GP? If I wanted to be, I'm listening to the Gray Report and I wanted to be an LP tomorrow, how would I go about doing that versus what are the barriers to entry to them becoming a general partner or a GP?
Yeah. Well, the good news is just about everybody can be an LP. Not an LP in every type of deal or syndication. Many syndications or investment opportunities are limited to accredited investors or some other type of limitation of having to be registered in a certain way to participate. The definition of accredited investor is you're an individual that's been making $200,000 a year for the last several years, or married, making $300,000 a year, or you have a net worth of $1 million or more. But not every syndication requires you to be accredited. So any individual or any LLC or any type of entity can be a limited partner or an investor. Now, to get into the GP, and this is what this is where the conversation get a little bit muddy. I mean, from a pure standpoint, a GP is typically, an individual or a company, again, that is putting the deal together, that manages and controls the business itself. It also relates to economics and control. And so really when we're talking about LP and GP, we're defining how the economics flows and who has control. And every single partnership or structure can be structured slightly differently, but generally, the LPs are going to put the majority of the capital into an investment, and they're going to get the majority of those returns. And the GP, or the general partner, is again putting together the deal itself, making major decisions, and is going to get a smaller portion of that return, but they're typically putting much less of their own capital in the project as the LPs. They might be putting anywhere between 5 and 20% of their overall capital, but they might be getting back anywhere between 30 and 40% of the overall return from the project. All depends on the economics.
Interesting. Sounds like we've kind of transitioned into deeper waters
Just
in regards
a little bit,
to the
yeah.
level of understanding. Let's go ahead and let's jump to that intermediate level of understanding. Obviously, there's a relationship that exists between the limited partner and the general partner. How might these terms, and you've briefly mentioned that they're more of kind of legal terminology, how might these terms kind of dictate the overall partnership or the agreement between the two parties, seeming that the limited partner appears to be supplying some of the equity capital or just capital in general, whereas the general partner seems to be, they may provide a bit of capital, but it seems like they're sourcing the project, they're operating, they're pulling the value levers, they're making the big decisions. How do these two terms kind of differentiate the role that each of these individuals or groups can play? And then at the end of the question is, what kind of liability maybe do these two positions have in regards to the project?
Yeah. So typically the LPs are going to have much more limited liability than the GPs. And the GPs, they could be taking on, minimal. They could be somewhat indemnified, or they can be taking on a lot of liability or a lot of risk. And the reason for that is because they're going to be compensated for the risk they're going to be taking by their piece of the promote or carried interest, or in other terms, kind of the piece of the deal that will flow to them for doing all of the work. A very standard setup is for there to be a split between the LPs and GPs. Once the LPs get all their money back, there's then a split, call it 70-30 between the LPs and the GP. So if there's $1 million that's invested, the LP contributes $1 million. Once that $1 million has been returned, you sell the property, you sell the business. Here's your $1 million back, limited partner. Any other profits that are left over, we're going to split 70-30, where 70%, so $700,000 in the $1 million total investment example, would flow back to the LPs. But then the GP, who may have put $0 in, receives 30% or $300,000. And it's because they guaranteed the loan, they did the work, they found the deal, they made it happen, and they executed. And that's why the bulk of their compensation is essentially coming from an incentive fee, or it's from the eventual sale and the profits that they receive from the business or the real estate.
So it seems like the terminology in itself of limited partner and general partner, they do have some legal framework, but they also are controlling or maybe a good descriptor of the economics of the deal and how the money will essentially flow through the investment lifespan.
Yeah.
Is that correct?
Yeah.
Awesome. What are we missing in that intermediate level of understanding between the relationship of a limited partner and a general partner?
Well, the one thing that can get confusing is that you can be a little bit of both. Some individuals, there's a thing called a co-general partner, and this is known as the kind of the sweet spot in investing for a lot of folks. It's not easy to do. You have to be at the right place at the right time with the right group. But that's essentially you are essentially a passive investor, an LP, but you get a slice of that GP. And typically the way that these are structured is that there's a limited partner investing entity or a holding company that the limited partners are members to, that's where they contribute their capital. And then there's typically a management LLC or a management entity that receives that promote or the carried interest. And that's that 30% of the deal that we were talking about earlier that will flow to the GPs. And so if I'm an LP, limited partner, and I want to invest in your deal. Like, Griffin, you've got a deal. You're coming to me. And you want me to invest. I might say, Griffin, I'll write the $1 million check, but I want a small piece of the GP because I want accelerated returns. I like the LP returns look good, but you need me. You need my $1 million because you're having a hard time raising the money.
Okay.
And so you really need my $1 million. For me to contribute that $1 million, I want a slice of your share. And so that's going to give me an outsized return because not only do I get my 70% on what I invested from the LP, I also receive a percentage of your 30%. And so assuming that the equity in the deal is more than just my $1 million, let's say it's $10 million, if you're getting, $300,000 back to the GP, and if I get a third of that, that's another $100,000, rough math, that's going to be coming back to me. And so it's stacking on top of my overall total return.
Trying to find a kind of a pressure point in the general partner, a basic need or a timeline need that you can fill, leverage that in order to boost your economics.
Exactly. And they could be a more, typically, you're supposed to have an active role if you are in the GP itself. You're not just supposed to be a passive investor. A lot of LPs kind of get around this by saying they're doing asset management, which is basically you're checking in, you're asking questions to the operator itself. Maybe you're touring the property every once in a while. But not just economics can be shared, but it's also control. and that's where it kind of deviates from the very simple LP GP relationship. LP is completely passive, GP is fully active. You could be an LP and say you're contributing 51% of the overall equity for the project. You may say, or maybe if it's less than 51%, but just again, Griffin, you need me to get this deal done. I'll say, all right, I will contribute my $1 million, but I want a percentage of your GP entity or your interest. And I also want some major decision controls. So I want to be able to I want to be able to maybe trigger to sell the asset. I might want to be able to, or I want to veto a refi or sale. I want to control any type of capital event. Maybe I want to have a provision in there that if you really screw up the deal, I can kick you out of the deal. Now you're going to push back on that, but
Definitely.
those are all things that are on the table. And this is all slightly different from a joint venture agreement or a JV, which there's typically is also, but not necessarily an LP-GP relationship.
Interesting. I feel like JVs might be next week's jargon bin.
It might be.
So
It's a preview.
the way that I'm understanding this middle ground is a limited partner can find a way to participate on the other side of the fence or the other side of the partnership and the general partner. I think you mentioned previously that the general partner or the GP can allocate their own funds as a limited partner and also play on the other side of the fence as well.
Yeah, I mean, you can structure this two different ways. There's probably more than two different ways. One, a GP, you can, as an individual or through your entity, you can invest either on the LP side or the GP side.
Okay.
And so that's either going to be your dollars are parked at the GP entity, and that GP entity then contributes those funds on your behalf to the LP entity itself. Or you can leave them separated and you have your GP interest, and then I'm going to come around and subscribe to the LP entity as an individual or as an entity to invest. And so you can almost ignore, like I might be a GP, and I'm going to get that promoted interest, and there's going to be some fees associated with it, but I'm also going to make an investment on the LP side. You're accomplishing essentially the same thing, but just through different avenues.
It's very interesting. Like you said earlier, you can muddy the waters, it can get quite complicated. Let's clear the waters before we get into the deep dive tank here. When we go into the industry veteran at a basic standpoint of those first two layers of understanding, seemingly appears to me that as a limited partner, an LP, you not only would be investing into the real assets or the investment opportunity, but you're also placing a large bet on the general partner to not only do what they say, but to conduct themselves in a way that is a steward of your capital in order to complete their business, objectives and investment strategies.
Yeah, at the end of the day, I mean, you're investing with the GP. Maybe you might be investing in a piece of real estate, but all of your trust needs to be on the GP and the sponsor, not necessarily in the piece of the real estate. You want to be trusting that your sponsor and your operator has the skill set and knowledge to invest in the real estate. I mean, maybe you're a real estate expert also, and you just don't have the time. But the reality is most LPs aren't day in, day out experts. All they do is real estate investment, or all they do is multifamily investment. All they do is property management. That is why you're partnering with an experienced operator on the GP side. And so the LP, very simply, passive investor, contributing capital, getting the benefits of real estate ownership without really any of the work. The GP, the active investor, they're taking the majority of the risk for the opportunity for an outsized return.
Right. It can be quite simple if you break it down like that. However, you want to get into the both sides of the fence, it gets a little muddy, but maybe that's for a deeper dive later. Let's go to the industry veteran side of this coin. You've mentioned joint venture. You've mentioned the co-GP, and what type of structure that we've used at Great Capital would be a great example to discuss. How muddy these waters can get with.
Oh yeah, we can talk about the Great
with
Fund.
Several different structures where LPs and GPs and co-GPs and JVs.
So Club Meridian is probably the more complicated.
Okay.
Deal structure. That deal involves a joint venture,
which is JV.
A JV.
Okay.
With Great Capital various Great Capital entities.
Okay.
Vehicles, and a independent, more institutional private equity firm. that's entering into a partnership agreement between Gray Capital associated entities and their entities themselves. And the difference between a joint venture, well, maybe starting just a very simple joint venture, typically is there is a sponsor of the project, similar to like a GP. But the investor on the JV side is almost always investing more than 51% of the overall equity. And so almost always they are going to be requesting, demanding, and requiring full major decision controls. So it's essentially like, look, we're going to be bringing in all the money or the vast majority of the money. That's our role. Maybe we'll also do asset management. They're going to look at the GP and say, you're going to run the deal for us. Maybe you're going to find it. You're going to operate it. You're going to ensure it's successful. But we're going to have basically complete control over this project, other than day-to-day operations. We'll let you decide what goes on a day-to-day basis. And so it's similar to that co-GP structure of where I'm in an LP. I'm mostly passive, but I've got some major decision rights and controls and some levers. JV is a little bit more of an extreme version of that and a little bit more formalized. So it's not like, I'm just a member of the GP and I have a couple rights. It's a true separation. And the economics are often, not always, a little bit different also. Where on a typical LP GP investment structure, like we've been talking about and Gray Capital often does, there's the LP entity and there's usually, like in our deals, there's a preferred return, which is a rate of return that accrues and is paid out in priority to before other cash flows are paid out to like the GP. And then there's a split, like the 70-30 we talked about. Where on a JV, there's typically a higher initial preferred return that typically gets paid out pro rata or pari passu between, let's say Gray Capital's investors and the JV investors. Everyone's going to get paid out a similar preferred return. But then as the property is sold and a positive internal rate of return or IRR can be generated, this is where we start getting into the weeds.
Right.
The splits, there's a series of waterfall splits. So it goes from, basically 12% to 0, 100% of the return goes to both the JV partner and basically the investors until they've hit a 12% return. Then the cash flow is split, say 60-40 between the JV partner and the LP and the GP itself. And then the split could go to 50-50 after, say, an 18% return. And so it front loads the return to that JV investor, but then incentivizes the sponsor of the project of the joint venture to perform, because potentially if they cross a certain threshold, they can be earning a much higher percentage of that remaining profit.
Right. It's obviously there's different roles to be played. There's different amount of risk to be played in each position. And it's not like you sit down at a table one day and you're just, hey, I'm the GP, I'm the LP. This is a joint venture. This is a co-GP partnership. There's a lot of negotiating. There's a lot of compromising that goes on. It doesn't just happen like that. And it's about finding the right partner in the right asset in the right market at the right time. So I think that when all of that comes together and it works, it can be, quite fruitful for everybody.
Yeah.
But there are also times where that negotiation maybe doesn't go as planned, and it can also potentially kill a partnership or kill a deal.
Yeah.
Can you just talk about trying to piece together all of those negotiations and things that otherwise would, make that negotiation go more smooth in regards to how Gray Capital operates? I know specifically here in-house, we really do like to hold on to those key decision-making factors when it comes to refinances or capital events.
Yeah. I've been involved in a lot of these negotiations and a lot of these deals in a wide spectrum. I've done deals where, again, it's an LPGP, syndication, relatively typical, and Gray Capital. We retain 100% of all the major decisions, control, all that. That's the most deals, to be honest. That's the vast majority of deals that we do at Gray Capital. I've also, before we were doing a lot of our own lead sponsored deals at Gray Capital, when I was doing a lot of co-GP investing. And you can go back, 8, 10 years ago and read some of blog posts that I was putting out about how to co-GP with syndicators. I don't talk about it as much because we don't necessarily want a lot of co-GPs today, because we don't really necessarily need a co-GP for most of our deals. But in some, we still do the bigger deals. And I think it's a great way to leverage someone else's experience before you have as much of experience yourself. So before I started being the lead sponsor at Great Capital and doing our own deals, and we've done almost 10 direct syndications, we have a couple of third parties. I had done 16 co-GP syndications where we were in we're in a GP seat with major decision controls with another operator. And so I've seen this done literally, now dozens of times. And it all started with an initial conversation of, again, needing to raise capital and needing assistance with loan guarantees, because there's a lot of, like, as you mentioned, there's a lot of different roles to put a deal together. You need the capital. You need to originate debt. You have to qualify for the debt. You also have to guarantee the debt. You can be a guarantor of the debt and not qualify for the debt itself. You can be able to guarantee, which is typically it's a net worth and liquidity component, but then you also need experience, and the lender is going to look at the aggregate of all of the borrowers or all the key principals, which are different. Guarantors also different, and so they can say, well, what is the whole team comprised of? Does someone on the management team or the GP side, do they have property management experience? Okay, they do. Okay, that sounds good. Do they have experience taking out these types of loans, which is a total chicken and the egg problem? And one of the main reasons why I started co-GPing, because I wanted to buy a multifamily deal. And the lender was like, I'd love to lend to you, but you don't qualify because I haven't lent to you before. I'm like, well, how do you lend to me for the first time? And he's like, well, just go partner with this guy over here, be a guarantor, and you can start getting this guarantee experience. So then when, like today, we go to Fannie Mae, we go to Freddie Mac, we go to these private borrowers, I've built out a track record now of guaranteeing loans, so that I have a great history of guaranteeing debt. So, but if you've never guaranteed a loan in your life, at the time I hadn't, but I had some liquidity. And so they were able to use that liquidity to help us secure that loan. So there's a lot of different, needs for that a GP, might require. And so, going through, it's negotiating what you need, how desperately you need it, and then how willing that GP is to give a piece of their own deal away. For our position, it was first just myself, then I wrapped my family into it. We created a real estate focused family office called Great Properties. I didn't have as much negotiating power at first than when I kind of built the larger team. And we built the larger team, we were able to say, hey, we want to put this deal together, and we want this to basically to exist for the next 10 deals. We don't want to just do one deal. We want to enter in a programmatic relationship under these terms. If you show us a deal that we like, we underwrite it, it checks all the boxes. These are the terms under which we would participate, and we don't have to renegotiate this every single deal.
Yeah, that's great.
Like, show us a deal, we like it, we're in, copy, paste, put it all together. We got, X percent of the GP, that we're going to attribute 10 to 15% of the equity, rinse and repeat. And we did 15, 16 deals like that.
That's awesome. Sounds efficient at that level.
It was, and it was a good time to do it, 2015
What's the
2019.
What's the main takeaway in this deep tank that we're diving in the LPGP, terminology and understanding for our industry veterans?
Never assume that two deals are the same, or two operating agreements are the same. Even you can understand, the definitions as we have defined them today, LP, GP, JV. All that matters is what's in the partnership documents.
Right.
So read your operating agreement. Never assume anything. Read your PP. You have to read the PPM. The PPM should really describe and sometimes go into greater detail describing the operating agreement, the roles and responsibilities. And one question that doesn't get asked that often from LPs is, who holds the major decisions? Who else is in the GP? Are we making decisions by committee, or is there one final decision maker? Or is there one decision maker except for a couple of other really material decisions? And then who is that person?
Right.
What are their incentives? Because they're not always the same as the rest of the LPs or the GP.
They might not be aligned. I think that's a common question that we probably don't hear enough in our LP investor onboarding calls is
Yeah.
who else is in the general partner. And in Gray Capital, we really do only have specifically one GP in our basic standard deal. If we get into a co-GP, we may have a second party or second entity in that general partnership, but there are syndicators, there are sponsors out there that otherwise have several entities, several individuals in their general partnership that otherwise may have a malalignment with you as a limited partner. So it's always good to investigate who is actually what that general partnership is comprised of, and who is again making the decisions, because that can certainly derail or accelerate a deal in the right or wrong direction.
I mean, just think about let's say you got some family office or something that's a GP with the decisions to trigger a sale, and something goes on in their portfolio, and they need a fire sale. They don't care. They just want their cash back.
Right.
It's a 10-year hold, but they don't care. They're in year 2. They're just trying to raise capital. They decide to take it to market and sell it.
That's a very good point.
To break even.
Yeah.
And that's not what the GP wants, but it's going to ruin their track record. It's not what the LPs want. They took their time to find this deal, but you've got Mr. Family Office Investor over here who doesn't care about any of that. They negotiated the rights. Now, how often does that happen? Not very frequently. The amount of times we exercise our major decision controls as a co-GP partner, almost never. But it gave us access to have conversations, and we certainly, have those.
Well, that wraps it up
Yeah.
for this week's edition of the Multifamily Jargon Bin. We're going to taper it down in the weeks to come unless it's a good discussion, but we're trying to make this timely. If you're a beginning investor or somebody that's just now discovering multifamily syndication, that first 10 to 15 minutes is really for you. Mm-hmm. If you'd like to see us tie it all back together, let us know in the comments. But again, if you find that there's value in this section, let us know. And I also noticed, Spencer, as we get deeper and deeper, there's more and more terminology that otherwise those novice or beginning investors would otherwise not know. Highlight those terms for us in the comments, because we'd like to know what to talk about next week and the weeks to come. Yeah,
that's exactly what I was going to say. If you're going to write a comment, please let us know what terms you would like us to break down. Not only just from the the dictionary definition, but our opinion and take on it.
Right.
Yeah.
There's a lot of terminology out there, so it's tough to just pick one a week and then talk about it without bringing in other terms and vocabulary to describe it and discuss its importance in multifamily syndication.
Very true.